Asia now has 225 REITs with substantial market valuations. To talk about this, we have Cushman and Wakefield's Chen. Catherine, what has changed to drive the growth of REITs within Asia?
If we look at Asia as one big market, one of the major growth drivers in recent years was the introduction of new REIT products in the emerging markets like China and India. So REITs were listed in the Chinese mainland only 3 years ago and in India 5 years ago. But now the two markets are the fourth and the fifth largest REITs markets in Asia, behind only Japan, Singapore, and Hong Kong. So incredible growth over the last 3 to 5 years. And they will continue to grow thanks to improving regulatory environments in both markets, as well as continuous policy support, such as expansion of REIT products in new property sectors in the C-REIT market. For the mature markets, growth is also observed in Singapore's REIT market as S-REITs continue to diversify their investment by acquiring overseas assets in high-growth property sectors. For instance, now over 90% of S-REITs own properties outside Singapore, which is an increase from roughly 60 to 70% 10 years ago. And by property sector, we saw increasing investment into logistics and data center assets by S-REITs. And these sectors generally have a better overall performance in terms of total return and capital appreciation in recent years.
And with that, what risks should we be aware of, especially with the current economy?
I would say there are both cyclical and structural risks, similar to the private real estate market. So without surprise, right now, the number one cyclical risk is elevated interest rate in most markets, which had a significant impact on the secondary market price in general. Currently, many REITs in Singapore, Japan, and Hong Kong are trading below their book value, with the exception seen in the logistics, healthcare, data center, and multifamily sectors. And this leads to my next point on potential structural or sectorial risks in the REIT market. So taking the Singapore REIT market again as an example, in 2023, the average total return of data center REITs was as high as close to 20%, while the average total return of office REITs was at negative 24%. So this illustrates the wide gap in terms of total returns among different property sectors, despite the fact that they all bear the impact of interest rate hikes. However, currently I see an easing in both cyclical and structural risks as interest rates are expected to moderate in most markets in the next 6 to 12 months, as well as expected recovery in both the office and retail sectors here in Asia. So overall, I would say the prospect of Asia REITs should look better going forward.
So considering all these factors, Catherine, how do you think can investors protect themselves from a potential recession when it comes to REITs?
Yeah, so when you buy a REIT, you are essentially buying a share of the underlying real estate assets. So understanding of the real estate market is key to successful REIT investment, in my opinion. And given its real estate nature, one should view it as a mid to long-term investment and as part of the buy and hold strategy, aiming for long-term capital gain while enjoying relatively higher dividend yields during the holding period. And it's always wise to diversify your REIT investment portfolio or buy REITs with diversified underlying assets, as data show that diversified REIT investment often lead to more stable returns over time. And it can also help mitigate some of the cyclical and structural risks. So in conclusion, long-term hold and diversification.
Thank you for joining us, Catherine.
My pleasure.
Once again, that was Chen, Head of Capital Markets Research for Asia Pacific at Cushman & Wakefield. For more news, visit realestateasia.com.